Good morning, everyone. This is Dana from NexGen, and I hope everyone has had a wonderful week. And if you have not done so, I hope that you had the opportunity to take a look at our home buyer seminar that we had last week. It was very good, a lot of good information. So if you need to, I will go ahead and put that in the link up at the top and also in the description. Today, I would like to talk to you about using your home's equity. And this is basically a part two to our multi-generational couple that was looking for ways to use their home's equity. So today, I would like to talk about reverse mortgages as one of the ways to use someone's home equity. But before we do that, let's go ahead and get into some definitions. So a lot of times people may not know what we mean when we talk about equity. So usually when you purchase a home, in most cases, you have a mortgage. And for this example, we're going to use a $500,000 home. So when you take on a mortgage for your property, you usually have to pay principal, interest, property taxes, and homeowners insurance. So the reason why I have the word escrow italicized is because escrow usually represents homeowners insurance and property taxes. So that's usually what your mortgage is comprised of: the principal, interest for getting the loan, and also escrow. And what escrow does is additional monies that's used where the lender will pay the property taxes and the homeowner's insurance. Now, in most cases, escrow is required depending on the type of loan that you have and also how much money you've applied toward the home. You may or may not have to have escrow. But the larger amount of money that you put towards the principal, and at the same time the house appreciates in value, that will increase your equity. So you could purchase the home with no mortgage. So that would mean that the equity would be a lot larger. For example, if you purchased the home with cash for $500,000, or you purchased it for a much smaller amount, but it was appraised at $500,000, then your equity would be $500,000. So we have mortgage, we have no mortgage. So whether you have a mortgage or you don't have mortgage, you're still going to be responsible for property taxes and homeowners insurance. Now, homeowners association is italicized because that is not something that applies to all properties. So some places do have homeowners associations and some do not. Now, there's a reason why I included it in this slide, and it will make sense once we start talking about reverse mortgages. So let's go ahead and talk about home equity on a $500,000 home. So this is the definition of home equity. It's the difference between the current market value minus any liens. Now, the liens could be various things. The liens could be the mortgage, if you have a mortgage on it, or some other things that we're going to talk about. But this is what we mean when we talk about home equity. Now, there's different ways that you can tap into the home equity. One of the ways is to sell the property. So let's say that you purchased the home for $500,000. We'll go back to our $500,000 home. And you sold it for $750,000. The difference, and I'm talking about closing, the difference would be equity. So that's one way that you can get equity out of a home, is to sell the property at a gain. Another way that you can get get equity out of the home is to refinance. So we'll go back to that same $500,000 home. Let's say it appreciated in value $750,000, and or you applied more toward your principal balance and you refinanced. You can take the equity or the difference out. So that's another way that you can take out or extract home equity. Another way is to have what we call a second mortgage. Now, you can have a second and a third and the fourth, but that is a mortgage in addition to the first mortgage. So that is another way that you can take out home equity. And then the last way is reverse mortgage. So there are some differences between the four, but we're going to concentrate on reverse mortgage because this is going to be a little bit different. So one of the differences are the qualifications. So what do we mean when we talk about a reverse mortgage? The difference between the reverse mortgage and the other types of mortgages that I talked about previously is that you're not making loan payments. It's actually the lender that's making the loan payment. And you can get the funds different ways. Now, the person that's getting the funds has to be an eligible homeowner. And that person has to be 62 or older, and they have to have a considerable amount of home equity to borrow against the home. And next time I'm going to talk about how much you'll be getting, or you could get. So you could get it in a lump sum, you can get it in fixed monthly payments, or you can get it in what we call a line of credit. And again, the difference is that in the reverse mortgage, the homeowner does not have to make any loan payments during their lifetime. Now, the entire balance will be due up to a limit, and we'll talk about that later. And it becomes due and payable when the owner passes away, when they move out permanently, or there's actually a time limit that I'll be talking about, or when they sell the home. Another difference between reverse mortgages and the other loan packages is that for a reverse mortgage, it has to be your primary residence. So you can sell the property and get equity. You can do a home equity line of credit. You can do a second mortgage or anything where on a rental or a second home or what have you. For a reverse mortgage, it has to be your primary residence. So your question would be, why would anybody want to get a reverse mortgage? Now, here are a few reasons why someone would use a reverse mortgage. Now, keep in mind, this is for eligible homeowners 62 and over. So let's say they don't want to make monthly loan payments. So whether they have a regular mortgage, a home equity line of credit, or a home loan, in this case, with a reverse mortgage, they don't have to make monthly loan payments. Well, let's say that they could not afford to make the monthly loan payments for whatever reason. Another reason would be is that they didn't qualify for a home equity loan or a cash out refinance that we talked about earlier because of poor credit or limited cash flow. Now, all these are reasons why someone would use a reverse mortgage independent of selling the home outright. So There are some different types of reverse mortgages that I wanted to show you as well. Now, these are the three types of reverse mortgages that are available. So out of the three, the home equity conversion mortgage is the one used most often. And that is the one that we're going to be talking about in the next video. Additional information on the other two will be in the description. Thank you again for stopping by, and I hope the information that I've presented here today was beneficial to you. Again, we're going to be talking about reverse mortgages, specifically the HECM mortgage, the requirements, and the different things that you would need to know to actually help you make a better informed decision. And next week, we also are going to have another home buyer seminar that specifically focuses on the investors. Again, thank you for stopping by. I will leave additional information in the description below. Don't forget to like, share, subscribe if you have not done so, and have a great weekend. And for my veterans, thank you for your service. And happy Veterans Day.